Welcome back, everyone. Today, my portfolio hit a very important milestone, and that is having $100,000 invested into the equity market. So in this video, I'm going to be going over 4 things I learned from investing $100,000 in the stock market. And this video is going to somewhat be geared to maybe beginners, and even if you've been investing a while, maybe you'll agree with some of the things. But I know a lot of beginners probably starting out investing want to hear from somebody that may be a little bit more experienced investing and what it's like to accumulate that amount and how to do it. Before we get into these things, if you do appreciate this content, give this video a like to get this content out there to a wider audience. It would be greatly appreciated. And also subscribe for future content. So first up on the list, the first thing that I learned is to diversify your investments. So what you see on the screen is 4 popular ETFs that I have. It is QQQ, VIG, JEPI, and SCHD. I'm not going to get into those ETFs specifically, but the important thing is number 1, diversification. You should have your assets spread out into a variety of different things. Now, whether or not you have multiple ETFs is up to you. You could always put your money into an ETF like the Vanguard S&P 500, VOO, which holds the top 500 largest companies in the United States. So some people would say that that is sufficiently diversified. You are diversified across pretty much all sectors. So with this extremely popular ETF, as I said, you're diversified among all these sectors in the equity market. So you don't really have the negative impact of a single sector possibly doing poorly. You're diversified across the entire market itself, and you're invested in every single thing. So not only do you have the ability to withstand a single sector downturn, but if a particular sector does well, such in this case, information technology has been doing very well over the past few years, you're also going to gain from that as well. So I know a lot of people put their eggs all in a single basket like information technology. It's diversified across stocks in the information technology sector. But what happens is if that ever does poorly, your investment will do poorly as well. And with the way equities go, if the entire market is kind of going up, it's possible that a sector that was leading isn't going to be leading in the future. Now, of course, that hasn't happened for some time. Information technology has been at the forefront of the US stock market, but that may, of course, change. Now, as far as me, I pick these ETFs for different reasons. Of course, I want to be diversified across the entire market as well, but I also don't want to have such heavy allocations in certain sectors. And I also do a combination of growth and dividend investing. So I'm kind of dabbling in both investment methodologies just to keep me broadly diversified, not only in the stock market itself, but in investment methodologies as well. Now, personally, this is not something that I specifically do, but some people even seek further diversification by investing in an ETF like VT or the like. That is the Vanguard Total World Stock ETF. And that diversifies investments not only in the United States, but across the entire world as well. So you're not only getting invested into the US stock market, but you're being invested into a variety of other economies across the world. So even if the United States itself does poorly, an ETF like VT may not do that poorly. So as you could see, the regions that this ETF invests in, it invests mostly, of course, in North America, but it also has holdings in Europe, Pacific, emerging markets, and even a little bit in the Middle East as well. So just keep that in mind. There's many different ways to diversify, and that is not even all of them. We haven't even got into diversifying into bonds or even into alternative assets like gold, but that is something that certain investors do. I'm not going to get into that in this video because that may be a little bit far out for a beginner. So with the S&P 500 performance on the screen, I bring you into thing number 2 that I learned, and that is that the market is going to have ups and downs. You are not going to expect to have a rising portfolio at all times. You are going to definitely see drawdowns all the time and expect them pretty frequently overall. You're going to see drawdowns. Of course, this was about 7%. But you shouldn't really too much fear a drawdown of even up to 20-30%, because as you can see, as the timeline gets larger and larger, you are going to, of course, the way the economy works, the stock market works, as the economy grows in a country, you are going to grow over time. And in fact, if you go further enough out, you will see that the S&P 500 is a index that has consistently grown over time. It is pretty foolproof. Even if there is a major downturn, you are still going to grow over time. So I can't really get that point across enough, because I know even, when you see downturns of 10%, 15%, you're of course losing your mind in a certain way, saying, oh no, I'm losing all my money. But then what happens is a lot of people will go about and sell. And then when they sell, they don't really know when to buy back in. Of course, they're timing the market. So if they sell right here or somewhere in that range, and then they don't buy back until a few years later, you're missing that run up. So a lot of the times, just keep in mind that it is often better to just stay the course than to try and time the market, because you're going to lose over time. And as this chart reflects, there really isn't a point after 10 years that the market has remained down. The economic situation in the country would have to be pretty bad overall. And there may be, at a certain point, more worries than just the performance of your portfolio if the economy of the United States remains low for so long. And that up and down of the market brings us right into the third thing that I learned, and that is dollar cost averaging is your friend. And now what dollar cost averaging is just buying all the time. Every time you get paid, if possible, and I really do hope you can, because that is how you compound your money over time, is consistently investing over time. But every time you dollar cost average, you're buying at the highs, but you're also buying at the lows. It's going to basically make these peaks and valleys less painful over time. So what this back test shows is a back test of investing $200 a month every single month from December 31st, 2014 until approximately the time that this video was made. And you pretty much see almost into November of 2023. I don't know why this chart isn't working at the moment, but it pretty much gets the point across. As you dollar cost average over time, it lowers the peaks and valleys of your portfolio, and it pretty much relieves you of anxiety, because a lot of people say, oh, I want to always keep cash available, so when I can guess when the market is going to be low, I can pretty much time the market. And what generally happens is you are not going to be able to forecast when the market is reaching a very high point or a very low point. The market can go up 10, 15, 20%, and you think you're at a high, so you sell. And then of course, when you sell, it can also go up another 10 or 20%. So you're going to miss out on that gain waiting for a dip in the market. So that works in the opposite as well, because if you are trying to buy up all at a market high and then it drops, you're obviously going to be pretty disappointed. But then since you're going to be dollar cost averaging, you are going to be putting your money into a point when the market is low as well. So you are going to lower that peak, allowing those contributions when the market is low to also grow over time. So I really can't get that point across enough, just like the last one. Dollar cost averaging is your friend. I think that it is one of the hallmarks of investing over time. And that brings me into point number 4 in a way. Not only does dollar cost averaging help you, but I think the most important part about investing over time that not enough investors talk about, because they speak about types of investments to make your money. But truly the most important thing about investing and putting money into the stock market, of course, this is going to be easier said than done, but increasing your salary over time. Because as you increase your salary, provided that you can keep your expenses low, you can contribute more and more and more. So if you're making $30,000, $40,000 a year and you think that you're going to get maybe a hot stock pick or even a conventional way of investing like VOO, but you can only invest maybe $100 or $200 a month after all of your expenses are paid, you're really not going to allow that snowball to grow as much as it could. So really, of course, again, easier said than done, but you really want to increase your salary so you have more and more money to throw in the market and then have that go over time. And that is also related in a way. having your money invested over time and having compound interest work for you is really paramount to building wealth over time. So let me show you an example of what having more money or putting more money in over time will do for you. So in this example, I said an initial investment of $1,000. You're contributing $250 a month, and let's say you are 20 years old when you started, so you're going to be investing about 40 years, and the estimated interest rate may vary, but I did it kind of inflation adjusted just to give you an idea. So at the end of that 40 years, you're going to have $614,000 just about, and honestly, that is pretty good for just this amount of money, $250 a month during that time. But let's say you say, okay, well, I'm going to really increase my salary, especially starting out into my late 20s and into my 30s. Well, if you do, instead of $250 a month, you do $500 a month because, again, you have that income, you don't have that much expenses, you can contribute a greater amount per month. Let's see what that works out to be. So you have $614,000, remember that number, and with that, you pretty much have a $1.2 million. So you see that just $250 difference over time yields you pretty much an extra $600,000, which is pretty impressive. And then the numbers just go even more and more over time. So say that you are contributing $1,000 a month, which really, if you think about it, is just $12,000 a year. And of course, that might be difficult when you're younger, especially when you have bills to pay. But look, if you job hop and don't get drawn into, stay with the company and get that annual 3, 4, 5% raise, if you job hop or really market yourself to your company to give you greater earnings over time, then that could definitely be achievable, that $12,000 a year. So that would make $1.2 million become $2.4 million. So really, you're going to be a multimillionaire by the time you retire on just contributing $12,000 a year. And again, I don't want to try and simplify it and make it sound too easy, but at the same time, it's really not too hard either. I think a lot of people, and even this especially is so when you're a married couple, you can kind of both combine your incomes to get this number. It might not be achievable in your 20s because, a lot of people have student loans or they're really setting up. They might just have children or something. There's going to be a lot of life factors that may influence the amount of money you can contribute into investing. But if you can get that and keep your expenses low, don't buy an unaffordable car, don't get that nice flashy new car with that $700 payment a month, get that used car or that really respectable low priced new car, and you can build that money over time into something very impressive. So yeah, as Charlie Munger once said, the first $100,000 is the hardest, and I think he used a little bit of a different terminology, but I'm thankful that I'm there, and I don't want to get confused. Of course, this can definitely dip below that even tomorrow, but it's definitely a good number to see, especially since I've been investing for a number of years, and just hitting that mark, I think, is an impressive milestone for myself. It's a good psychological thing that I did this to the point where I achieved a number that is really sought after, and of course, this is just going to compound over time, and I'm going to keep you guys up to date with it over time, of course, too, as I make these videos. So thank you all for watching. Please remember, if you did enjoy this content, give this video a like to get this content out there to a wider audience. It will be greatly appreciated, and also subscribe to keep up to date on future content, and I'll see you all in the next video.